What's changed? Are you aware if Morgan Stanley's doing anything differently?
We were just doing their balance sheet today.
Okay.
We're doing a fun little analysis, and the analysis is how cheap is Morgan Stanley, right?
Okay.
And of course, when you do that, what you do is you take your balance sheet, you say, okay, got the balance sheet, I am going to own Morgan Stanley. So I own Morgan Stanley.
Right.
I own Morgan Stanley, then I can shrink repo and shrink reverse repo. And then shrink governments and shrink commercial paper and shrink corporates, and longs and shorts net against each other, right? And you do the analysis of doing a liquidation of the balance sheet, right? And so when you're doing this, you immediately say, ooh, look at how the funding's changed. And, much bigger deposit base, right? Much bigger deposit base. Much less commercial paper and bank loans. A massive pool of liquidity held on the balance sheet that has to be running a negative carry for them. And these are things that just sort of show up, which is the liquidity presumably is either a rate, and you don't know. You don't know whether the liquidity pool is required by the rating agencies or whether it is required by the Federal Reserve. I suspect there's something of both. But it's a recognition that the old contingency funding plans had a flaw built in.
I see.
Right? And that these events can happen very quickly. And so I need a surge. I need a surge pool to protect me from when something bad that were to happen tomorrow. And the one thing we ran across was are they using more customer collateral in retail for funding their margin loan? Because you can't tell from just the disclosure on the balance sheet. But it sure looks like that. It looks like you're using, if in an old-fashioned brokerage firm, I mean way back, back in the 70s or 80s, if she wants a margin loan, so I write a margin loan. Should I give her money on the margin loan? I've got her collateral in. I can take money out of your account to fund her margin loan. So I can just take your cash, give it to her. She's giving me collateral. Now I'm long collateral, and we're seeing these IOUs to retail clients that aren't treated as deposits. So it's a payable to a retail client. And I've asked myself the question, is this because they realize that retail money is very sticky and safe, and that they've gone back to what they view as a very safe way of funding margin loans. And then I've asked myself the question, is this funding hedge funds? Because that's a different issue, right? If I'm in the same broker-dealer, you can't tell. You can't tell. But you look at the balance sheet and you say, wow, this is a much more conservative balance sheet than the last time I've taken it apart.